myself. So, well, thank you. I'm Luke Stein. I just want to first start by thanking the Becker Friedman Institute and the organizers for having me today. And this is joint work with Elizabeth Stone. She was a classmate of mine at Stanford, now at the Analysis Group, and a former options trader at Merrill Lynch. And there's going to be some data from options markets here, something that I've worked hard to understand as well as Liz does, and learned a lot from her. So this paper is going to attempt to be an empirical investigation of some of the questions that models we've heard about today have tried to speak to, in particular about the effect that uncertainty might have on decisions firms make. And I'm going to be looking at investments in long-lived production inputs in the spirit of the model that Nancy Stokey laid out earlier, although when I take this to the data, I'm not only going to be looking at investment in capital, but also in hiring workers, which involves training costs and other things that give it the character in some ways of an investment good. I'm also going to be looking at investment in knowledge inputs to the production process, investments in intangible goods. And in particular, I'm going to focus a little bit of my empirical attention on firms' investments in R&D. So there's decisions to invest in R&D, but also just a tiny little bit at advertising, although I'm going to have less to say about that, partly because the data isn't so good. As was suggested in several of the presentations earlier today, I think motivating the importance that uncertainty has for firms is perhaps less important in this audience than it is in a more general one. But let me just point first, Scott showed actually some time series evidence on statements by the FOMC in the Beige books. Just pulling out one from a few years ago, the FOMC noted that market participants reported uncertainty about economic outlook led firms to defer spending projects until the prospects for economic activity became more clear. Larry Summers channels an example that actually comes, I think, originally out of the Bernanke 1983 paper that's gotten a lot of play today. Basically, you know, if you think about General Motors trying to decide what kind of plant to build, maybe if they think gas prices are going to be high, they're going to develop against making the Chevy Volt. If they think gas prices are going to be low, they might make a new plant to build Suburbans or other large cars. If they don't know what gas prices are going to be in a few years, maybe they're just going to hold off and not build that new plant or not hire those new workers until they have a better idea where oil prices are going. So in this paper, there's actually going to be no theory. So for those of you who have a strong appetite for theory, I hope the presentations before and after mine sate your appetite. This is going to be an empirical investigation of how uncertainty affects firms' investments in these productive factors. And it's going to use microdata on a firm-level measure of uncertainty, or firm-level measures of uncertainty that principally come from options prices, but I'm also going to look at a few other things, partly as a robustness check. So just by way of further motivation, if we looked at macro data, which again is not the main source of estimation I'm going to use, the green line here is basically, this is like a VIX index, and the orange line shows a NIPA aggregate for gross domestic private business investment. And if you do the sort of most naive, I think sometimes they call this interocular regression, you kind of squint your eyes and look at the lines, these things have a negative co-movement, and that's borne out. You don't even have to buy the Stata MP in order to estimate those things. Of course, as we saw in the last presentation, but in line with intuition, economic uncertainty is higher when the business cycle is bad. And so perhaps the fact that we're seeing lower investment at times of heightened uncertainty, it might not be that uncertainty is causing firms to invest less. It may just be that the heightened uncertainty is an epiphenomenon, or rather that the heightened uncertainty is a consequence of the recession, and that the lower investment is just an epiphenomenon. So it's actually the recession that's causing firms to invest less or hire fewer workers. And this kind of naive analysis, even if you do it on the computer, is leading us to draw misleading conclusions about the causal consequences of uncertainty on investment. Now, these kinds of findings aren't only true for capital investment. They also hold for hiring. Before I show you the data on that, let me just note that, that economists sort of believe that that's true for hiring as well as they do for capital investment. So this past summer, Foreign Policy magazine surveyed 62, I didn't put the quote on here, I think they call them of the most distinguished economists in the country. I'm a little bit disappointed to see that of the 62 most distinguished economists in the country, I think Steve Davis is the only person in this room who made the list. Anyone else is welcome to raise their hands. I didn't get it on the slide. So 31% of the 62, when asked what's the single most important reason U.S. jobs have not returned more quickly, cited uncertainty. And we would at least like to think that not only Steve, but also the other 61 on this list are reasonably sophisticated and understand that this is a question asking them perhaps to separately identify first from second moment effects. Indeed, the second most popular response was weak aggregate demand. So if we exclude Steve, we get 18 out of 61 rather than 19 out of 62. It's still the modal answer, although it drops from 31 to 30%. But it does seem like there's an economist's intuition, at least, that kind of the Larry Summers, Bernanke, FOMC intuition from the last slide holds not only for capital investment, but also for hiring. Your sort of naive time series interocular regression again suggests this is true here. For hiring, the evidence is slightly less clear when we look at aggregate data on research and development. That could perhaps partly be true because the data on R&D suffers from significant shortcomings relative to the data that we have on aggregate investment and hiring. But perhaps it looks a little bit like R&D starts to fall going into 2010, I think, is the last calendar year for which this data is available from the BEA. Obviously, by aggregating up from my sample of firms, I'm going to be able to extend the data analysis forward here. It just sort of says, well, we don't really know what we might expect to find. So I think microdata has something to say that adds to what this macro data says. The big challenge in estimating the effects of uncertainty, I think, is establishing causation. So it's separating these first from second moment effects, and it's also recognizing that in addition to there being emitted variables in regressions like you might run on that time series data, where there's first moment things that we're leaving out, it could actually be, especially at the firm level, that investment causes uncertainty. So there may be some reverse causation, and there's a literature that exists partly in the accounting literature, which has used firm-specific data to provide some evidence that this actually happens. So when firms engage in new investment projects, especially large investment projects, the market recognizes we don't know what the returns on this new plant or this new project is going to be, and so uncertainty for the firm, measured in one of a variety of ways, sometimes tends to spike in the wake of new investment projects. So not only are we concerned about emitted variables and a bunch of measurement challenges, we also recognize there could be reverse causation. That means that looking at simple correlations could point us in the wrong direction. And this, I'm not the first to recognize this problem, obviously. There's been a lot of empirical attention that's been given to this question, but it's a hard problem. And I think even the people who've done the best work in this area acknowledge the shortcomings of most of the existing solutions, which have typically relied on a number of time series assumptions about the underlying stochastic processes. So typically attempts to causally identify the effect of uncertainty in these types of microenvironments rely on assumptions about lagged levels being plausibly exogenous for current differences and lagged differences being exogenous for current levels, and using GMM estimates that rely on those types of time series assumptions. I think they do a good job considering the limitations that those assumptions require. This paper is going to take a slightly different approach. I am going to use microdata, but I'm going to use variation that comes from macro shocks. And in order to get from macro shocks to micro effects, I'm actually going to use variation in how exposed different firms are to those macro shocks. And the intuitive idea behind the identification strategy in the paper, I'll have more to say about this in detail, is perhaps illustrated by thinking about 3 industries and 1 commodity market. So if we imagine, for example, what happens when oil prices spike? So if energy prices go up, if you're an oil refiner or you make oil and gas field services, that's great news for you. It turns out that intuition bears out in the data, and I'll show you some of that data a little bit later. So as measured, for example, by the co-movement of firm share price returns with oil price movements, on days that oil prices go up, guys in the refining businesses' stock prices tend also to go up on those days. It looks like it's good news for them. On the other hand, if you look at what happens to airlines on days that oil prices rise, that's bad news for them. Airline prices tend to fall on days that oil prices rise, and that's perhaps not surprising given that oil is a big input to flying planes. They're very fuel intensive. And so this is a big negative profit shock for them. In contrast, it turns out if you look at the general retail sector, that's just one that kind of comes out in the data as having virtually no co-movement of firm share prices with oil share price movements. So I'm going to come to the second moment in a second, but if we just think about the first moment, if we just think about what happens when oil prices go up or oil prices go down, oil prices going up looks like good news if you're a refiner. It looks like bad news if you're an airline. It looks like no news, really, if you're a general retailer. Okay, now let's think, yes? Okay, so I absolutely agree that that there are a variety of different mechanisms that underlie these correlations. So it may be that the reason airline share prices move negatively with oil prices is that it represents a cost shock for airlines. It may be that for refiners, this represents a demand shock or is correlated with a demand shock that hits the refiners. So despite the fact that this conference is focused on economic policy uncertainty, I'm going to remain fairly agnostic as to whether these correlations, are driven by demand shocks, input price shocks. The other sets of commodities that I'm going to use are foreign exchange rates. And the mechanisms there may be things not only like demand shocks or the cost of imported inputs, but also the availability of financing for multinational firms, competition faced from foreign imports, and a variety of other mechanisms. So I recognize that there are a variety of different things that might underlie this. I'm not actually going to have anything to say about what the underlying mechanisms are. Sorry. So let's think now just for a second, stepping from first moments to second moments, about what happens if all of a sudden oil uncertainty rises. So if gas prices become much less certain, that introduces a big source of uncertainty for oil refiners. To the extent that oil prices co-move with demand shocks for their product, uncertainty about oil prices perhaps represents uncertainty over future demand shocks for those firms. And to the extent that airlines have a big cost share coming from gas prices, when oil prices become more uncertain, that introduces a big source of uncertainty for airlines. In contrast, if you're a retailer and you don't care very much about gas prices, then uncertainty in gas prices doesn't really or shouldn't really introduce much uncertainty for your firm. So in a sense, the intuition that underlies what will ultimately be an instrumental variable strategy that I'll describe in more detail a little bit later in the talk is that while oil price shocks hit oil refiners and airlines in opposite directions, oil uncertainty shocks hit oil refiners and airlines in the same direction relative to firms like retailers who are less affected by oil uncertainty shocks. That's kind of the underlying intuition. So there's going to be some variation coming across industries. There's going to be some variation coming over time from the fact that energy prices and uncertainty are moving, and they're not moving. They do co-move, but they don't co-move one for one. And then the final source, in a sense, of identifying variation is this non-monotone relationship between the sensitivity that firms have to first moment shocks and the sensitivity they have to second moment shocks. So I'll have more to say about that, but that's kind of where I'm going. I'd like to think that if we left now, you'd have some idea of what's behind the identification. The other thing I would want to make sure that you left with if we have a fire drill is something about what I find. And here's what I find. So when uncertainty is higher, which obviously given the identification strategy really means for firms that are affected by higher uncertainty when uncertainty is higher, it turns out they're going to invest less in capital and they're going to hire fewer workers. So this is very much in line with the intuition that comes out of Nancy Stokey's model she presented earlier. It's in line with the intuition that many of the models summarized, perhaps most famously in Dixit and Pindyke's 1994 book, suggest. This idea that investment can be depressed by heightened uncertainty. The magnitudes are fairly large. So if we scale up the estimated effect of uncertainty on investment or hiring by the degree to which firm-specific uncertainty rose during the Great Recession, so let's say kind of 2007 to 2009, we multiply those together to see what it would predict in terms of the drop in capital investment or hiring, we get big numbers. We get numbers that are, let's call them about a third of the overall aggregate drop. So in those time series I showed you before, in the Great Recession, hiring in the US fell by about 200%. Capital investment fell by about 35%. I'm going to get that about a third of that seems to be operating through the uncertainty channel. If we look at R&D, we actually get the opposite signed result. So I find that when uncertainty is higher, firms actually engage in more R&D. And that's perhaps surprising if what we have in mind are models like the Dixit and Pindyke ones. I think Nick was perhaps teeing me up a little bit by asking Nancy a question about what happens when their investment lags. Barlow and Strange have an AER paper where they point out that, in fact, when there are long lags between investment and investments paying off, perhaps actually investment has more the character of buying access to a project in the future. So rather than investment representing the cash that gets put against some project, you actually start to engage in R&D now. In 2 or 3 years, you're going to be able to cash in and try to commercialize that project, but you don't have to. You can always abandon it. And so you acquire an option for future competition by engaging in R&D now, given the long lags before projects pay off. And given that, and that options generally become more valuable when uncertainty is higher, we actually could get that that R&D is encouraged by heightened uncertainty. That's the finding in the paper as well. They have some numerical simulations, but no data in that paper. I find that uncertainty depresses advertising. I'm not going to focus very much on those findings, but it at least suggests this isn't something highly idiosyncratic about the way I'm treating data on intangible inputs like R&D. So where am I going? I'll tell you a little bit about the data I use, a little bit more detail on the estimation strategy, the instrumental variables, and how they work, what the estimated sensitivities are. So before I told you airlines don't look like oil refiners, but I'm going to actually estimate that in the data rather than taking that sort of out of thin air. I'll go through results, which I've already summarized, and then very, very briefly conclude at the end. So if you want to estimate the effect of uncertainty on investment, the main thing you need is some data on uncertainty and some data on investment. I'm going to measure uncertainty, or let me start with investment because that's the way I did it on the slide. All of this data on firm behavior is going to come from CompuStat. So right away, this is a universe of publicly traded firms, which, as Steve noted before, are only sort of, they're a reasonable fraction, but still only a fraction of total aggregate U.S. activity. And there's even some further slippage beyond that because many of these guys are multinational, and so their activity is not necessarily taking place in the United States. I'm apples to apples because my uncertainty measure is also going to be for those firms, including their international activities, but comparisons to the NIPA aggregates and other things necessarily involve a little bit of a fudge. The CompuStat universe is a highly unbalanced panel. It covers about 23,000 different tickers going back many, many years. I'm actually going to measure uncertainty using the prices of equity options. So according to an options pricing formula like Black-Scholes, options should become more valuable, ceteris paribus, when uncertainty over future outcomes or future profits faced by the firm is more uncertain. We can invert those options pricing formulas and use the fact that options are traded and priced on the market to figure out, in a sense, what market participants forecast of future firm earnings volatility or share price volatility is. So to the extent that this is a good measure of uncertainty over the things that matter to managers, there's, in a sense, 2 assumptions. One, that the relevant sources of uncertainty are getting priced into the firm's share price. So first, we're kind of treating share prices as a sufficient statistic for relevant information. And then secondly, that uncertainty over those future share prices is getting translated into the price of equity options on those shares. This actually limits the sample even more. So not only now are we talking about publicly traded firms, we're talking about big publicly traded firms because those are the guys who tend to have equity options trading on them. I am also going to look at another uncertainty measure that allows me to move to the whole CompuStat sample. Honestly, I find that there's not much difference between the 24,000 CompuStat firms and the 7,000 option metrics firms using that other measure. And so I'm not going to have much more to say about heterogeneity by firm size, big and small firms. We match these two together. The options data is the binding constraint because it goes back to 1996. This gives a sample of 6,600 companies. There's some additional sample restrictions. We're down to about 4,000 companies averaging 5 years each, where the key estimation period is going to be 2001 to 2011, so the last 11 years, basically. I'm going to estimate the simplest possible linear investment models. So I've called this flow and stock, but if you want to have this in mind, think the flow is like I, investment, and the stock is like capital. The typical way you might see this is I over K. So we're looking at what fraction of the firm's current capital stock does it invest in each, in my case, year. I'm going to be mainly looking at annual data, but I'm going to use identical estimation specifications to look at the effect of hiring as a fraction of the labor force, or R&D spending, that's investment in a certain kind of knowledge input, as a share of the dollar value of the knowledge stock, If you want to talk about how you measure the dollar value of the knowledge stock or of the advertising stock, I'll be at dinner and I'll be here tomorrow. Now's probably not the right time to do that. There's some standard ways, and that's basically what I do. So we have something like I over K on the left-hand side, and an annual frequency for samples in my firm. This average is 23%. So in the average year, firms are investing a gross amount of 23% of their prior end of year's capital stock. And I'm going to look for linear effects of two key regressors. The first is sigma. So in my main specifications, that's going to be that forward-looking uncertainty measure. It's a measure of how much fluctuation the market participants expect the firm's share price will face over the next 90 days. And I'll tell you about the units that that thing is measured in a minute. I'm also going to include a first moment control. In the main specifications, that's going to be Tobin's Q. That's a normalized market-to-book ratio. You can think of it as the share price of the firm divided by something. There are many people in this room who know much more about Tobin's Q than I do, I suspect. But for those of you who know less about Tobin's Q, you can think of it basically as a normalized share price designed to try to pick up the first moment effect of the quality of the investment opportunities available to the firm and the expected return on those investments going forward. And also my estimation specifications are going to be fully saturated with firm fixed effects and time fixed effects. So to the extent that some firms tend to have higher investment or hiring levels than others, in a way that's constant over the sample period, those will get picked up by the firm fixed effects. To the extent that there are macro shocks that hit every firm in the sample in a common way, those are going to get picked up by the time fixed effects. So what I'm estimating off of is the residual effect, or the heterogeneous effect, if you will, of uncertainty measured at the firm-specific level after taking out the fact that there may have just been a big hit in investment that hit everybody in the economy all at the same time. Yes? Yes. So it certainly could cause problems. One of the ways that I'm going to try to do with that is, as I sort of alluded to when laying out the identification strategy, my instruments are not only going to be for variation in the second moment coming from, let's say, oil price uncertainty shocks affecting firms. I'm also going to instrument for my measure of Tobin's Q using these heterogeneous first moment shocks. So oil prices are moving, and some firms are more and some firms less affected by that.
That helps with endogeneity, but I guess here's the question.
Yeah.
Q is just famously bad as the first moment.
Yes.
And if, let's say Q is not correct, and you want Q and Q squared and Q.
Yes. So I am not going to show them today. So there's some things I'm going to show today and some things that I don't have in here but I've done. So for the non-capital investment outcomes, and in many ways capital investment is the place that Q kind of could or should do the best. You can at least really write a model where Q is the right thing to have in here for capital investment. It's less clear how you would do that for hiring. I'm going to use some alternate first moment controls and find similar results. Something I'm not going to show today, but I've done, is we can also run these estimates just leaving out the first moment controls and estimating the first moment effects basically using only the time fixed effects. We know that that represents a misspecification. We actually get results that are surprisingly similar to what we get when we include them. I've also run specifications where I include Q but don't instrument for it using the commodity shocks. It doesn't seem like it makes a big difference how we do this. Yes?
Some of the work on investment is not focused on the sigma, it's on the vertical stuff.
Yep. Sorry, the goods are, so who's doing the investing? Yeah, the investing price is fine. Right.
Well, what you're going to do later is problematic. You have the time effect just like the price of investment.
So it's a very good point. So I think I have to think a little bit more about what the time fixed effects are doing given that. So the Q is measured here. Obviously, it's a firm-specific Q control. So to the extent that With macro data, using a macro first moment control wouldn't pick up the fact that there's sort of distributional effects across firms. I might hope that I'm doing better at that by using firm-specific first moment controls and looking at the effect on those specific firms. But I'm not entirely sure that I understand. Yes.
They give up all the investment, but they don't have to, other firms, big manipulate.
Okay.
And the press is investment through price. So you're investing through that. Effect on aggregate investment is real investment.
Okay.
Because you don't have the price of investment to sucked into your time.
Okay, so I think I understand a little bit better. I'm not sure, so you should tell me if I'm off track. What I'm going to do later when I try to aggregate these things up is I'm not going to use an aggregate uncertainty shock in order to try to sort of aggregate this up to find macro effects. I'm actually going to look at what's the effect firm by firm that would have been predicted by the uncertainty shock that specific firm faced. And then I'm going to aggregate up by adding those total investment numbers measured in dollars. And so I'd hope that the reallocation is actually going to get treated there. For example, if it's going from big firms to small firms, big firms are doing more investment, small firms are doing less investment, something like that, that the aggregate size is going to get picked up because I'm going to add investment dollars to dollars. What I'm not going to do, I agree, is I'm not going to get the piece that's affected by the time fixed effects. Yes. So to the extent that if we want to think about the total effect of uncertainty shocks on aggregate investment and that part of that is operating just through the common effect, I guess we could think of my aggregation as a lower bound because I see. Okay, so if we think of investment as being basically substitutes across firms rather than... Yeah, that was okay. Limited stock. Yeah. Yeah. So it's a great point taken. I think I need to think a little bit more about how it affects the interpretation of these results. When I estimate these specifications, I'm going to treat both the firm-specific uncertainty measure and the firm-specific Q measure as potentially endogenous, measured with noise, but also affected by the effects of emitted variables or reverse causation. Yes? Maybe try like industry Q but industry more slow to modify Yes. So in the OLS estimation, because I am going to show some OLS results despite the fact that I think there's issues with them. In the OLS results, there is going to be firm level variation in Q. Because my variation in sensitivity is actually going to be at the industry level, so I'm going to look at airlines versus refiners. I'm not going to look at United Airlines versus American Airlines. In the second stage of the IV, I am, in fact, using a fitted industry level Q for exactly some of the reasons that I think perhaps you have in mind in suggesting that. So thank you. Okay, so in an attempt to address the endogeneity of both Q and the uncertainty measure, as I said earlier, I'm going to construct a set of instrumental variables that are perhaps correlated with exogenous changes in firm-specific uncertainty, but also the firm-specific first moment measure. And they're going to come from energy prices, but also from a set of, not a single index exchange rate, but a variety of different dollar exchange rates. I think especially in the wake of some of what we've seen today, one could imagine also using something like the Baker et al., I'm going to call it the Baker et al. Index, he comes first alphabetically, index almost as another commodity. So in a sense, the identification strategy should be valid for a broader set of commodities broadly conceived. But right now, I'm going to look at energy prices as well as foreign currency exchange pairs between the dollar and a variety of currencies. And I'm going to form for each commodity C 2 instruments, one of which tells us how exposed a firm's Q is, although every instrument serves to instrument every endogenous regressor, but how exposed firm I is to the price of commodity C, which is going to be the product of two pieces, the sensitivity that that firm or industry has to movement in the commodity market, and the price of the commodity in that period. So if there are any labor economists in the room, this has a little bit of the flavor of like a Bardic-style instrument from the labor economics industry. The sensitivities are only going to vary in the cross-section. You'll notice they're only index I. And then commodity price and volatility are only going to vary in the time series. The volatility exposure, every time I do that, the volume changes significantly. The volatility exposure instrument is constructed similarly, except instead of using the price sensitivity, I'm going to use, in a sense, a volatility sensitivity, which is just going to be, by imposition, it's going to be the absolute value of the sensitivity that firm share prices have to commodity prices. And that would come out of the simplest linear model, where firm value is a linear function of the underlying commodity price, and the sensitivity just represents the coefficient in that linear equation. So as I kind of suggested before, 3 sources of variation. One is price doesn't perfectly co-move with volatility. Second is sensitivity varies across firms. Third is there's this non-monotonicity in the sensitivities in constructing the 2 instruments. Yes. Mm-hmm. Yes. So the exclusion. Okay. So I think this. You raised 2 good points. So the first is, well, isn't Larry Summers saying oil volatility matters for firms? And I don't think that represents a violation of the exclusion restriction. I think that represents support, in a sense, for the inclusion restriction. It's saying that when commodity prices move, that matters for firms, and it's going to affect the uncertainty that the firms face. So but I do think we have to talk a little bit about the exclusion restriction, so you're right to bring it up. So in this case, the instruments aren't obviously just movement in commodity uncertainty. They're about the interaction between the commodity uncertainty and the sensitivity that the firm has. So the exclusion restriction here asks whether we think there's going to be a differential effect of, let's say, oil volatility on firm investment, differential in line with these sensitivity measures, but that does not operate through its effect on firm-specific uncertainty. So we don't just need that it matters. It's actually great that it matters. It's the fact that the firms are sensitive to oil uncertainty that makes their Tobin's Q move up and down and their firm-specific volatility move up and down. So I don't know if that kind of addresses the concern you're raising, but okay. Yes, and it is, but right. But what I need is for it only to I need all of the effect to be measured in the firm-specific uncertainty component. But I don't necessarily need I don't precisely need that to be true, because the exclusion restriction demands not only that uncertainty not affect, or it doesn't demand that uncertainty not affect investment directly. It demands that this differential effect of uncertainty on investment not operate differentially other than through the way that it affects firm-specific uncertainty measures. So I have more instruments because I have more currencies. Yes, in theory. In practice, testing over identification restrictions in this setting is difficult, partly because the variation is occurring at kind of the block level. So that the variation is common across industries, and they're all getting hit by common shocks. But that's something I'm happy to chat with you about afterwards. Yes. Yes. So, it's partly precisely because of concerns like that. I would say that's, in some ways, that's a bug, not a feature of the strategy. So to the extent that firms are investing in order to change their sensitivity, we might be worried about an endogeneity or a violation of the exclusion restriction that's coming from the fact that heightened uncertainty induces firms to try to avoid exposure to commodities markets or something like that. So it's partly precisely to deal with that concern that, A, I'm only allowing these sensitivities to vary at the industry level rather than at the firm level, where I think it's more plausible that we can sort of treat them as exogenous and not responsive to firms' individual decisions to try to do things like hedging or otherwise avoid exposure. And that's also part of why I'm not allowing the sensitivities to change. I know that the sensitivities do have some fluctuation over time in reality, but I'm going to hold them fixed here. I recognize that in a sense that weakens the first stage. Right? I could get a much stronger first stage if I actually allowed these sensitivities to move over time. In the extreme, I could get a perfectly fit first stage, but that's kind of the classic weak instruments problem. So I'm holding the sensitivities fixed in order to avoid this endogenous response. I lose some of my predictive power in the first stage, which lowers the power of my estimates, but I try to avoid the endogeneity problem that might result if firms are responding sort of intentionally. Thanks. Okay, so there is at least one key thing here I told you during the introduction, but I haven't told you in any more detail, is where do these sensitivities come from? And the sensitivities are actually estimated. They're estimated using models a little bit like what Jonathan and Andrew showed us earlier when they estimated betas in share price return models using economic policy uncertainty. Here, I'm going to use not uncertainty on uncertainty betas, but rather level on level betas. So how much does, this is the return of the share price on firm I, so this is the return on American Airlines. How does their share price do on day T as a function not only of overall market price return, so beta SPX is in line with your classic kind of CAPM style beta, but also measuring betas on each of the commodities that are included with my first stages. So I'm going to estimate the degree to which firm share prices co-move with commodity price movements, and this is where firms like American Airlines are going to show up at one end, and firms like Texaco are going to show up at the other end for reasons both having to do with kind of endogeneity concerns, but also just to do with precision of the estimates. These things are fairly noisy. I'm only actually going to estimate the betas at the industry level. So I'm going to use firm level data, and I'm going to estimate this using daily changes in share prices, but I'm going to restrict those betas to be constant within the industries. I'm not going to estimate one for American Airlines. And I'm going to do that using 1996 to 2000, which is, it's a pre-period relative to where I'm going to estimate my first and second stages. So my main results are all going to be based on 2001 to 2011. I don't want to use the same data that I used to estimate these sensitivities for exactly the reasons suggested by this comment that firms may actually be trying to respond to uncertainty movements to reduce their sensitivity. I need some extra data to do this, daily data on stock price movements, daily data on commodity price movements. We're also going to use, in order to construct these instruments, data not only on oil prices and exchange rates, but also data on energy price volatility and on currency exchange rate volatility. Fortunately, there are also options that trade on those things, and so we can back out options implied volatilities not only for individual firms, but also for these commodity series, and that's where the volatility data is going to come from. So when I estimate the sensitivities, there's a list in the paper of the extreme industries as well for the currencies. I'm just going to show the energy price sensitivities today. We get some things that we might expect. Furthest extreme at the left is scheduled air transportation, so there's your airlines. Oil and gas field services, crude petroleum and natural gas are out here. There's a bunch of guys in the middle as well. And again, there's this non-monotonic relationship between how these sensitivities, as listed from top to bottom, should relate to the effect of energy price shocks on firm share price movements versus energy uncertainty shocks and firm volatility movements, or firm implied volatility movements. So we're going to estimate these sensitivities. The energy price series and energy volatility, they do have some co-movement, but it's not actually perfect. So in the post-2001 period, at a quarterly frequency, these things have like a negative 0.2 correlation coefficient. So we're not just relying on that non-monotonicity. We also have the fact that first and second moment shocks are coming at different times from the underlying commodities. And the last thing I'll show you before I get to estimation results is mainly just a series that's going to try to help provide some context for interpreting the magnitudes that we're going to see in the regression tables. So the blue line is basically the VIX index. This is a market-wide implied volatility measure that we saw in the earlier slides. The green series is just the mean firm. This is like the simplest unweighted average in my sample, which is an unbalanced panel of firms. And the green line just traces out what happened to options implied volatility over the next 90 days for the average firm in the sample. So at the end of every quarter, we're looking and saying, what is the market, how much does the market think this firm's share price is going to fluctuate over the next 90 days? The units are in an annual standard deviation. So kind of a mean 2003 or so through 2006, 2007 of 0.4 means that the market was forecasting for the average firm a plus or minus 1 standard deviation change over 90 days would correspond to a 40% annual share price movement. That's about 3% per day. And in fact, during that era, if you threw your dart at the Wall Street Journal, there's about a 2/3 chance that it would land on a share that had risen or fallen within, plus or minus 3% on the previous day. There's some fat tail problems that mean that's not literally true. The orange line looks not at the implied volatility from options, but at the realized volatility. So this is, in a sense, the most naive measure that we could get, rather than the very sophisticated uncertainty forecasting models that were described in the last talk. This is literally, let me look at the last 90 days, and let me look at the standard deviation of daily share price changes. There's many more sophisticated things we could do. This is really, we're not trying to get fancy with this, and so we kind of intentionally chose the simplest possible thing. Just note that as we go into the Great Recession, firm-specific implied volatility, so the green line rose from about 0.4 to 0.8. It doubled, so an increase of about 0.4. Realized volatility actually rose quite a bit more. It nearly tripled from 0.4 to 1.2. So if you want, you can keep those numbers in mind, but I'll remind you when we get to the next slide. Yes, Casey? Yes, they are. So all of these are measured in annualized standard deviation of changes. I'm happy to leave it up here as long as you'd like, but I can also. No, I'm not. I'm not stingy with any of these slides, but this one, we can all put it together. So let me tell you about what I find. So all the regression tables are going to be laid out more or less the same way. I'll spend a little bit more time on this one. So these are estimation of a linear regression of a linear investment model. So the dependent variable is I over K. It's investment this year divided by capital at the end of last year. And the first column just looks at OLS. So this is correlative evidence that I wouldn't want to interpret necessarily as causal. The timing convention is as follows. Implied vol is indexed T minus 1. That means the implied volatility as of the end of last year, but it's a forward-looking measure. So it's as of the end of last year, what did the market think was going to happen looking forward 90 days into, let's say, January, if you have a year-end fiscal year. Tobin's Q is Tobin's Q as of the end of last year, but again, that's a forward-looking measure to the extent that the firm's share price captures future cash flows. And we find, in line with what we might expect and what we've seen in the time series graphs, a negative correlation between firm-specific uncertainty and firm-level investment. And obviously, this is after taking out the time-fixed effects and the firm-fixed effects. When we move to instrumental variables, so now instrumenting both implied vol and Tobin's Q using those currency and energy sensitivity measures, okay, we get an effective volatility on investment that's somewhat larger. I don't really want to place too much stock in the difference between these two coefficients. They're statistically indistinguishable, and there's a lot of caveats always about doing hypothesis testing on the difference between the IV and the OLS coefficients. But with all of those caveats in mind, if we thought that uncertainty depresses investment, but that investment causes heightened uncertainty, so when I build a plant, we don't know whether the plant is going to be profitable or not, that causes uncertainty, we might expect the OLS coefficients to be biased down towards 0 due to the reverse causation. You'd need some additional assumptions about the timing through which these mechanisms operated. And again, I mean, these are statistically indistinguishable, but the OLS is indeed smaller than the IV. That's also in line with what you might expect if you think that Tobin's Q and the uncertainty measure are captured with some noise, which is likely perhaps to be the case. We find positive coefficients on the first moment measure. No big surprise there. When times are good, firms tend to invest more. Just to give you a sense of this magnitude, so if we take that 0.09 coefficient and we multiply it by 0.4, which was the size of the volatility shock, or sorry, the increase in firm-specific uncertainty for the average firm, we get 3.6 percentage points lower investment rate for the average firm on a base of average annual investment of 23%, percentage points, percent of the capital stock. This suggests that the uncertainty channel is consistent with about a 16% fall in investment. Now, I told you we can't exactly compare these to the NIPA aggregate numbers, but during the Great Recession, NIPA aggregate private domestic business investment in the US at an annual frequency fell by about 30% peak to trough. So that suggests these magnitudes are in line with something like a half of the very largest changes that we saw in aggregate numbers. Yes, Casey.
I want to ask for a little help on interpreting
Okay.
options around equity.
Yes.
And I guess, like the financing model for the other model, speaking to the prospects for the assets.
Right. So okay, so to the extent that the options are picking up uncertainty about the value only of the equity share of the value of the firm, but perhaps the relevant thing is about the entire enterprise value of the firm, we might be getting some mismeasurement here. Is that the flavor of? Yeah, so I've done some looking at what happens if we try to kind of leverage adjust these options implied volatilities. It's not exactly clear what you should do with the debt piece when companies are anywhere near the bankruptcy threshold. By and large, it doesn't seem to make a big difference in what we find. I'm very happy to talk more about that later. I would be happy to talk more about it now, but if you don't mind, I'm going to defer it only because I keep catching these time signals. It's a bad excuse, but I hope you'll take it. I'm just going to spend another minute on this slide because I do want to show you what I find in the other guys. But if we move from using options implied volatility to using realized volatility, we get smaller magnitudes. But again, recall that in the Great Recession, realized volatility rose much more than implied volatility did. And if you multiply these by the size of the right-hand side fluctuations, you get left-hand side effects that are just about the same magnitude. Doing this also then allows us to move to a sample that's between 2 and 3 times as big, because we're no longer restricted to firms that have options trading on them, and we get effects that are statistically indistinguishable. There's some other tests we can run on firm size, and we don't get much. For investment, we can also look at quarterly data, because there is capital investment data quarterly. We get effects that are similar, but that I'm not going to talk about right now. So just another way of thinking about what the magnitudes look like. So what this graph does, the green line is the actual investment rate aggregated across all of the firms in my sample, which again, recall, it's an unbalanced panel, so there's some funny things going on in the background. But the green just says, if we add up all the firms in the sample, what happened to their investment rates? And the orange says, well, what comes out of the linear regression model if we just take fitted values? So this is, I guess, 4 things. It's the Q, it's the uncertainty, it's the firm fixed effects, and it's the time fixed effects. The firm fixed effects matter only because of this panel unbalance issue. I've also put the NIPA aggregate on there, but I'm not going to talk about it. So one way that we could imagine kind of trying to quantify a counterfactual would be saying, Well, what happened if we leave the time fixed effects the same, we leave the firm fixed effects the same in order to take into account panel balance, we leave all of the firm Qs the same in order to kind of leave this first moment effect, but what would happen if we just held everybody's idiosyncratic firm-specific volatility, so not idiosyncratic, but firm-specific volatility, constant at the level it had been in 2006? So we basically take out the part that's coming from the coefficient on the uncertainty measure, okay? And we find that if we hold vol fixed at its 2006 level, capital investment falls by a little less than half of what it would have in 2009, a little more than half of what it would have in 2010. If we hold both vol and Q fixed, we get falls that are obviously somewhat smaller. So, the kind of gap between this number and staying constant is, in some sense, the fraction of the capital investment fall that's explained by the fluctuation in volatility. Okay, if we run the same exact exercise for the hiring rate, we again get larger effects in instrumental variables than we did in IV, consistent with the way we might expect reverse causation to go. Okay, we get effects that are half the size given double the change in uncertainty using the realized measure rather than implied, which is consistent with what we get for the full CompuStat sample. There's also an alternate first moment control that we use in place of Tobin's Q here. If we run the same kind of counterfactual exercise here, we kind of get, well, actual hiring in our sample fell by a little over 200%. Had volatility stayed at the level it had been in 2006, hiring likely would have fallen only by a little less than 100%, so something like a third of the total effect size relative to constant hiring being explained by the uncertainty channel. Okay, for R&D, we get basically nothing in OLS, in line perhaps with the very mixed evidence we saw in the aggregate time series. Okay, bless you. Under IV estimation, we get a fairly large positive effect of uncertainty on R&D spending. And this is, again, consistent with the possibility that with long investment lags, R&D may actually represent the acquisition of an option to compete in the future, an option which is more attractive to hold when uncertainty the firm faces is higher. Again, we sort of get magnitudes that are in line with the difference in units for the right-hand side variable. Perhaps some evidence that the R&D effects are larger for smaller firms. But again, nothing we can really state strong statistical evidence on the difference between those coefficients there. So here, for our firms, again, and with a bunch of caveats, R&D in our sample falls from about 21% of the knowledge stock to 18% of the knowledge stock, would have fallen by about twice as much, the model suggests, if uncertainty had been held constant. So the heightened uncertainty actually encouraged firms to engage in more R&D. Of course, at the same time, during the Great Recession, we went into a recession, okay? And good times encourage firms to invest more in R&D. It turns out, if you kind of multiply those effects on Q, you get more or less back to where you started. So the estimates suggest that, in fact, sort of had we managed to have a recession without an increase in uncertainty, firms might have invested in more R&D, but it's not surprising we didn't see a bigger aggregate fall because the effects of the first and second moment shocks go in opposite directions. We get big negative effects of uncertainty on advertising, perhaps unsurprising to the extent that, I am told that if Coca-Cola, one of the largest advertisers in the country, wanted to, they could make a phone call tomorrow, and by next week they would be spending twice as much. There's no long lag times to build this stuff. So unlike with R&D, it is also an intangible investment good. The fact that we get this negative effect suggests perhaps we're not, mismeasuring intangibles in some deep way, but rather that it is something like the investment lags associated with R&D investment projects that don't exist for advertising that may drive us back to negative here. So basically out of time, I think, at this stage. Let me just briefly conclude. This paper introduces a new strategy for identifying uncertainty shocks. It uses macro fluctuations, in my case, commodity volatility shocks as well as commodity price shocks, but I think also would be a useful strategy to use around something like an economic policy uncertainty index to the extent that there's variation like what we saw this morning in how exposed different firms might be to government policy. Okay? We show in the paper that exposure to energy and currency volatility prices are correlated with firm-specific uncertainty and Q measures. The evidence for that I didn't really point to, but it's really the first stage estimation results. Some evidence that implied volatility of stock prices from equity options can be an appealing proxy for uncertainty. In fact, we wind up getting very similar results whether we use the implied volatility measure or the realized volatility measure. That said, I think especially as the options data sets extend in time and long-term options like the leaps become more widespread, this type of data will have more and more ability to speak in a more detailed way about what the form of the uncertainty firms face is in terms of duration over which they face different risks, and also actually parsing out what are tail risks, what are upside risks versus downside risks. The fact that there's a rich set of options that expire at a variety of dates and strike prices means that we should ultimately be able to tease more of that out, although we don't do it here. Finally, that the negative effects of uncertainty on investment, hiring, and advertising are big. They're enough to explain, let's call it a third of the aggregate falls that we saw in capital investment and hiring during the Great Recession, larger than what we would see just looking at OLS, but effects that go in the opposite direction for R&D, in line perhaps with what we might expect given long investment lags, or the fact that R&D may have particular kind of strategic attributes that make it more like acquiring the option to participate in some project in the future rather than actually capitalizing on that option now. So I'm going to leave it there. Thank you very much for your attention, and I'll look forward to speaking with you all over the next few days. Thank you, Steve.